Hello and welcome to PPC Money Matters, a channel that covers everything regarding stocks and investing, personal finance, and opportunities as a self-employed in the finance industry. I'm your host, Finn, and today we're going to talk about one of the biggest stories of the year, the collapse of Silicon Valley Bank, or SVB for short. SVB was established in 1983 as a bank that specialized in serving technology and life science companies, especially startups and venture-backed firms. It was the 16th largest commercial bank in the U.S., with over $200 billion in assets and nearly half of all U.S. tech companies as its customers. But on March 10, 2023, SVB collapsed in a spectacular fashion, becoming the biggest U.S. bank failure since the global financial crisis of 2008. So what happened to SVB and what does it mean for the tech sector and the broader economy? How did it affect investors and depositors? And what can we learn from this episode to improve our investment decision-making? These are some of the questions we will try to answer in this video. To understand how SVB collapsed, we need to go back to the early days of the COVID-19 pandemic in 2020. As you may recall, the pandemic triggered a massive shock to the global economy, causing businesses to shut down, consumers to stay at home, and markets to plummet. However, the tech sector was one of the few bright spots, as people relied more on digital devices and services to cope with the lockdowns and social distancing. Tech companies saw their revenues soar, their valuations skyrocket, and their cash piles grow. Many of these tech companies used SVB as their bank of choice, depositing their cash with SVB for payroll and other business expenses. SVB, in turn, invested a large portion of these deposits in long-term U.S. government bonds, including those backed by mortgages. These bonds were considered very safe and offered a steady income stream for the bank. However, things started to change in 2021, when inflation began to rise sharply due to supply chain disruptions, labor shortages, and pent-up demand. The Federal Reserve responded by raising interest rates rapidly to cool down the economy and keep inflation under control. This had a negative impact on bond prices, which move inversely to interest rates. In other words, when interest rates go up, bond prices go down. SVB's bond portfolio started to lose significant value as interest rates rose. This would not have been a problem if SVB could hold on to these bonds until they matured, when it would receive its principal back. But as economic conditions worsened over the last year, especially for the tech sector, many of SVB's customers started to withdraw their deposits. SVB did not have enough cash on hand to meet these withdrawals, so it had to sell some of its bonds at a loss. This led to a destructive cycle, where SVB sold an increasing number of bonds at a loss, resulting in a decrease in its capital base. As a result, its credit rating was downgraded, leading to an increase in funding costs. The increase in funding costs further eroded SVB's profitability, which caused its share price to plummet. This decline in share price, in turn, led to more customers panicking and withdrawing their deposits, exacerbating the situation. On March 8, 2023, SVB announced that it needed to raise $1.75 billion in new capital to plug the hole caused by its bond losses. This alarmed investors and customers alike, who realized that SVB was in deep trouble. A run on the bank ensued. Within 48 hours, SVB collapsed. The U.S. government stepped in to guarantee customer deposits and prevent a wider contagion in the banking system. It also shut down Signature Bank, another regional bank that was teetering on the brink of collapse due to similar problems. The government sold off most of SVB's assets to First Citizens Bank, a larger and more stable bank that agreed to take over SVB's operations. The collapse of SVB sent shockwaves across global financial markets. It triggered a sell-off in tech stocks, as investors feared that SVB's failure would hurt the liquidity and growth prospects of tech companies. It also sparked a flight to safety among bond investors, who dumped riskier corporate bonds and sought refuge in safer government bonds. The yield on the 10-year U.S. Treasury note fell below 1% for the first time since 2020. The collapse of SVB also raised questions about the health and regulation of the banking sector. How could such a large and prominent bank fail so quickly and unexpectedly? How could regulators miss the warning signs and fail? So what can we learn from this? Well, one thing that we could do is to remember that the world of finance and investing can be unpredictable. And the collapse of SVB serves as a stark reminder of this fact. It's crucial that investors do their own research, consult with trusted professionals if necessary, and consider their own risk tolerance when making financial decisions. Thank you for tuning in to Money Matters, a channel brought to you by Pinnacle Personnel Consultancy. PPC is a dynamic and innovative company. We're committed to providing exceptional networking events and fostering connections within the finance industry.